as I said, I'm Matt Bennison, co-manager of the Schroder Income Growth Investment Trust and of the Schroder UK Alpha Income Fund, which is an open-ended UK equity income vehicle. I've been at Schroders for 10 years, 7 of those within UK equities, began as an analyst, progressed to taking on fund management responsibilities in what's called the Prime UK equity team at Schroders. And I've spent 3 or 4 of those years co-managing income mandates alongside my boss and the head of UK equities at Schroders, Sue Nofke. As you know by now, it comes no surprise that I'm going to be talking about investing for income. The title of the presentation, Out of a Pandemic into a War, summarises the environment that we've been dealing with for the last couple of years, because I do think it's worth looking back before we look forward. There's a lot of what's happened in the last 18 months really dictates where we are today, because in 2020, what was a pretty dependable asset class, that is income, suddenly became not so dependable. And you've already been given a good teaser of that from Russ. And it really is amazing how much a crisis hones your knowledge and experience. So I've put this pack together to share some of those from the last 2 years, and then we'll get on to how that's changed the landscape of UK income investing. Because I must admit, it was pretty acute in March and April 2020, when we took on the management of a new income mandate after the departure of a colleague, and we set up the strategy in line with our thinking. And as this phrase goes, everyone's got a plan until they get punched in the face. And a few weeks later, we were in amongst a pandemic, the biggest dividend crisis in history. You'll see the headlines as this slide shows that Royal Dutch Shell had its first dividend cut since World War II. The banking sector was prevented by the regulator in the UK from paying dividends in amongst the uncertainty. And we'd actually increased our positions in the banking sector shortly prior to the crisis, which we sold out of quite quickly given the uncertainty. So what did that mean for us day to day? Well, it meant that we were going through week by week models of when we were expecting companies shares to go ex-dividend. But even that wasn't necessarily enough, because the company's dividend at that time could have been declared by the company, but subsequently payment of it could have been cancelled due to the circumstances. So it really was a stark reminder of some of the things that Rhys was talking about earlier, that dividends are very much a discretionary return of capital made by companies. And from our perspective, it became very clear how important it was to defend income for clients, many of whom relied upon income to fund their day-to-day lives, or perhaps charity clients who rely on it to fund their operations. And the stats, as you can see on the left-hand chart of this slide, were pretty stark. During the crisis, 2/3 of companies in the UK cut or suspended their dividends. Payouts in the FTSE 100 fell by around 35% in 2020. Payouts in the FTSE 250 fell over 50%. In total, income across the market almost halved from a peak of 110 billion in 2019 to 60 billion in 2020. These are figures from Link Asset Services, and I recommend those as a provider as a source of income-related data on the UK market. So that took income back to levels last seen in 2011, so wiping out a decade of growth. So what happened next? Well, fortunately, I'm pleased to say we're past the nadir. We saw a very strong recovery in 2021, as that chart shows, to over 90 billion of income. So what drove that rebound? And this is where we start bringing ourselves more to where we are today. Well, to start with, clearly it was restored dividends across the market as it became clear that peak uncertainty had passed. That started with the more defensive sectors such as non-life insurance, defence, consumer staples, utilities, many of which had strong balance sheets and good cash generation and robust earnings profiles, which has afforded them the ability to carry on paying dividends in the uncertainty. It was also from businesses that perhaps whose trading operations benefited from the pandemic. But finally, one thing that Russ has alluded to earlier, one of the biggest and still biggest contributors is the mining sector. And you can see the headline on the right-hand side of the chart there, Rio Tinto in this period paying the second largest dividend ever from the FTSE. Now, why was this and why is this? Because, if we take the recent price action in commodities as a result of the war in Ukraine as an aside, As COVID rolled on, it became apparent that governments needed to put a huge amount of stimulus to work to boost economies in the recovery from the pandemic. And also became apparent they were going to perhaps try and use that to stimulate a green recovery, because this is what happens when you need to electrify the grid. You need a lot of copper. When you need to build a lot of wind turbines, you need steel, which comes from iron ore, which you need to dig out of the ground. And this led to the market to forecast a very, very strong demand environment for commodities, which pushed their prices up, which led to the mining companies reporting extremely strong earnings. And we'll go into the sector contribution to dividends a little bit more later. But essentially, these mining companies, they have what we call mechanistic payout ratios, where they tend to pay out in dividends a fixed percentage of their earnings each year. And as their earnings go through the roof, as commodity prices do, the dividends follow. So on aggregate, this slide shows that, across the market, we haven't yet returned to the levels of 2019. If we go over onto the next slide, what do we expect for 2022? Well, on an underlying basis, this is a chart, again, as mentioned, for Link Asset Services. They expect underlying dividends to increase around 11% from 2021 as companies trading carries on improving. We've seen a recovery in the commodity prices. And also one of the big comebacks sector-wise has been from the banking sector, because clearly those dividends went to essentially zero during COVID. These banks are now pretty well capitalised businesses. And if we think about a bank like Lloyds Bank, over the last few years, they paid over £20 billion out in PPI claims. And that is over half of Lloyds Bank's market cap. So if they go into reasonable income generation mode, then that gives an idea of the extent to which these companies could return paying income back to shareholders in the coming years. What are the questions or the headwinds that we could face in this period? Well, the mining sector's has got a very positive earnings environment at the moment, but we must remember that those earnings are pretty cyclical, because if there's a concern over a growth slowdown in China or a general global growth slowdown, which would impact the demand for commodities, then the earnings of those mining companies would fall. During COVID, they represented around 25% of the overall income of the index. So if their earnings fell materially, then dividends would fall in unison, and that would be quite a big headwind to the income from the index. One of the benefits of being an active fund manager is that we can rotate the portfolio to deal with these aspects and try our best to defend income. As I said, on the other side of things, we've got perhaps the banking sector, which is potentially set to benefit from interest rate rises, which would be positive for those earnings and positive for the dividend potential. And even though we think that it might take 2, 3, 4 years for income across the market to return to levels that we last saw in 2019, one thing I would say is that there's an argument that the dividend income now is perhaps healthier than it was previously, because many UK PLCs went into the crisis perhaps with too much debt, or having been put under pressure by investors to over distribute their earnings prior to the pandemic. And that's one of the reasons we saw many even defensive businesses cut their earnings cut their dividends during the pandemic. Companies such as BT, Vodafone, Imperial Brands, which Russ was talking about earlier, perhaps cut to a much more sustainable level. So let's have a look at the sector breakdown and how this has changed in this period. Well, if we start with where we were prior to the pandemic, you can see that the biggest contributor was the purple bar there, which is the banks and financial sector, which contributed around 25% of the index, the UK index's income. Now, clearly, as the banks were cut to zero during the crisis, that's been a big headwind, and we're starting to build back now. That's much smaller if we go to the top chart as a percentage of the overall index income. And what's picked up the baton from that? Well, it's been the resources and the commodity sector in the light blue. I've already discussed that one at length. Also, some of the more resilient businesses, perhaps in the consumer staples sector, which is highlighted in green there. So you can see the puts and takes that occur. And another one that we've not actually covered yet is the oil and gas sector, which is shown in the pink there, which was a very large contributor to the index's dividends in 2019. And this is another example of a sector that perhaps went into the crisis with unsustainable levels of dividend payment. Now, why do I say that? It's because there's a number of calls on the capital of oil and gas companies. One is maintaining their own operations, their own oil and gas fields that they have in the ground. Number two is perhaps pivoting their businesses towards renewables. So that could be wind turbines, that could be hydrogen. That's going to be quite capital consumptive, and also an important thing to do both for the future of those franchises, and the companies under a lot of pressure to do this from a societal perspective. And the third call on their capital is paying excess cash back to shareholders. And we felt going into the pandemic that they were going to struggle to satisfy those three calls on their capital. So it could well be a very positive thing that both Shell and BP cut their dividends in the pandemic to more sustainable levels. And given the oil price environment we now have, where oil price has gone over $100 in the last few months, the earnings of the oil and gas companies are very strong, which affords them to be able to pay well covered, nicely growing dividends again. The emphasis there being on the sustainability of those dividends. So where does the UK income sector sit in terms of attractiveness relative to other global markets? Well, this chart was one that Russ alluded to before, just shows how, despite those cuts, the dividend yield of the FTSE All Share is still at a nice premium to other global markets, be that Europe, be that emerging markets, be that Japan, or be that the USA. And not only does it look attractive from a percentage dividend yield perspective, it's also well covered by earnings now. As the earnings of businesses have recovered during the pandemic, the FTSE 100 dividends are now over 2 times covered by their earnings, and the FTSE 250 dividends, the mid caps, are now over 3 times covered by their earnings. So that means that not only are companies paying dividends to shareholders, they've also got excess cash to invest in their operations and growth opportunities that they have. So that gives us some confidence in the resilience of this income stream and the potential, very importantly, of it to grow over time. And it's that growth that we view as important when we construct our portfolio, because this chart here shows how we think about income fund managers. You know, we're very conscious that we view the job as a twofold task. One is generating income to satisfy shareholders today, but another is securing growth for tomorrow. And with inflation very much back front of people's minds, the growth element is going to be very important through cycle to try and have a dividend that grows in line with or ahead of inflation. And how do we do this? Well, what we do is we employ what we call a barbell approach, where around 50% of our portfolio would be in those businesses which are at the bottom of that chart in the red. They might be lower absolute dividend yields, but they are franchises with strong growth opportunities ahead. So they may not be paying the bulk of their capital back to shareholders in the form of dividends. We think that's the right thing to do because they've got good growth opportunities for the future. So even though the dividend yields might only be 2 or 2.5%, they can grow at 7, 8, 9, 10 or more percent as the earnings of these businesses do, given their growth opportunities. Around 25% of the fund broadly we might have in businesses that are yielding in line with the market average, perhaps somewhere between 3.5% and 4%, that have some growth opportunities, but perhaps not the same extent as the ones in the lower of growth bucket. And finally, the balance, which is the final 25% of the portfolio, is in businesses that have high, but what we would view to be stable dividends. So these will typically be companies with strong balance sheets, strong franchises, attractive margin structures, good cash generation. And despite being high dividend yields, we like to see them being well covered by earnings and cash flows for all the reasons that Russ was alluding to earlier. So these can be sectors such as financials, mining, and non-life insurance. And I say mining there because even though I was talking about that as a cyclical sector earlier, the mining sector does most of the companies within that now do have very strong balance sheets, because they went through their own crisis in 2015-16 as commodity prices fell quite heavily. The companies went into that crisis with weak balance sheets, have spent the subsequent 4 or 5 years strengthening those. So it means that even in the event that the commodity prices fall, the strength of the balance sheets means that the majority of those earnings can still be returned to shareholders. So they still have attractive dividend yields, even in that environment, in our view. One other feature that's perhaps worth drawing out is just that the feature of investment trusts specifically, which means they can hold revenue reserves. Because when income is generated by the holdings within an investment trust, only 85% of that is mandated to have to be returned to holders of the investment trust during the year. So what that means is that you can hold back in what's called a reserve up to 15% of income generated. So you typically try and do this in good years. You'd see it as a rainy day fund, and this came to the fore very much so during COVID, where even though the income generated from the portfolio as a result of the cuts during the crisis perhaps didn't cover the dividend required to be paid by the trust, you can dip into those reserves, which means that at an aggregate trust level, it can carry on paying and growing a dividend through cycle. So that's another feature that I'd recommend considering when thinking about investing in investment trusts. So to sum up, we believe that UK equities represent an attractive income opportunity with a dividend yield that's a significant premium to other markets, backed by earnings streams that are well covered by that cover the dividends well. And we recommend, as I say, taking a barbell approach when you consider investing in income, so you can make sure that you satisfy income requirements today, but also have an eye on being able to grow that perhaps in line with or ahead of inflation in future. So on that note, I'll look forward to your questions and hand back to Russ. Thank you very much.